I'm Robert Cardoza, and you're watching On the Street, the intersection of business and politics. And we are now into my very favorite segment of the show, and that's the emails. And the reason it's my favorite part of the show is because it's an interaction with you. I'm finding out what you're interested in knowing, and I'm interacting with you. And having said that, I want to remind you that you can follow me on Facebook, Twitter, LinkedIn, Google+. I want to encourage you to email me at robertcardozalive@gmail.com. And I also want to encourage you to go to my website at robertcardozalive.com. I need your input so I can make this show your show. After all, that's what's going to keep the show on the air. Now, let's talk about the emails. And my first email comes from John Wilson from San Marino, California. John's saying, I'm considering a C corporation versus a subchapter S corporation. How does that affect my ability to move money around? I'm used to just being a sole proprietor and just depositing the check and spending the money. I've been told that the S corporation is a lot easier to do that. How do I do that as a C corporation? Well, John, you've got a couple of problems. As a C corporation, you're not going to do that. Both have benefits to it. So let's talk about the C corporation first. Now, a C corporation is a closed corporation. It's a separate entity in the eyes of the law, and it has to report its own taxes, pay its own taxes, do all of those things. Now, as an officer, if you're an owner, you're the officer of that corporation, you're required by law to take a salary. Now, you can get bonuses throughout the year, but it's also going to be earned income. It's going to be reported on a W-2 subject to withholding taxes, and that's how you get your money out of a C corporation. Now, if you're the stockholder, or maybe the sole stockholder, maybe you have investors that are with you too, what will wind up happening is that when you get down to that net income at the end of the year after all your expenses, you'll divide that by the percentage of ownership of all of the shareholders. They then will get a notice of, okay, this portion of these profits belong to you. Now keep in mind that if you're a C corporation, you paid tax on that net profit at a corporate tax rate. Then when you sent that out to those shareholders, that became a dividend. Now dividends right now, if you earn less than $400,000 a year as an individual or $450,000 as a married person, you're going to pay only 15% on those dividends. That's a good deal, good tax ways to go, but there aren't any other real benefits other than some of the fringe benefits that you can get from a C corporation. But on a subchapter S corporation, you still get all that corporate protection, you still have the stock, but in that particular case, it doesn't pay its own taxes. When you get down to that, you do have to pay yourself a salary, just all the time, and generally that salary has to be at least 30% of your net profit, but all the other profits then flow to you right to your personal tax return, and you report that on your personal tax return. The nice part about that is that part that just flows to you is not subject to self-employment tax. That's Social Security, Medicare, and you're going to save 15.6% on every dollar by not paying that. That's a good thing, and you can still pay yourself fringe benefits. You can lease yourself equipment. You can do all kinds of things that really make that beneficial to you. Now, one of the things that we've always done is tell people, hey, look, in your corporation, if you have a legitimate corporate entity, whether it be a subchapter S or a C corporation, what you want to do is you want to buy assets yourself and lease them to your corporation. You say, well, why would I not just buy them through the corporation? Well, here's why. If you buy it through the corporation, you have to depreciate these assets over a period of time. If you lease it to the corporation, you still get to depreciate the assets because you own it in their income property, but the corporation gets to take 100% of the lease cost as a tax deduction, and that's a loophole the government gives you to take a double tax deduction going on there. I'm sure you can see that. Depreciation over here, lease cost over here. You can lower your net income artificially and pay many, many, many dollars and less in taxes. And that's the real benefit to a subchapter S corporation. But the more stockholders you have, the bigger your company, the more arguments you can make for being a C corporation. The good news is, regardless of whether you incorporate as a C corporation or as a subchapter S corporation, you can actually convert that one way or the other. So if you started off as an S corporation, you can convert it to a C. If you started off as a C corporation, you can convert it to an S. But once you do that conversion, you're required to keep that in place for a minimum of 3 years. But it's the only way to go. If you're in business, it protects your liability. It does all of those things. Now, here on the street, I want to remind you that we're brought to you by Biz TV, TiVo, Ustream TV. We're available on YouTube, and I want you to go to youtube.com and just search Robert Cardoza Live. All our shows are going to be right there for you. It's really important. You know what? You're watching On the Street. This is the intersection of business and politics. This is where I make every effort to get all of the data available, put it into a funnel, work it out, give you the honest-to-God truth, good, bad, whether you like it or not. And that's what you get right here on the street. I'm Robert Cardoza.